Good afternoon, my name is Kelvin Tan, private client dealer from Phillip Futures. In this episode of Market Watch, I'll be sharing where the Aussie dollar will be trending towards in the near term. We saw two interest rate cuts this year, first in February and the second in May 2015. This resulted in a reduction of the cash rate to an all-time low of 2%. But instead of retreating, the Aussie dollar pair strengthened from a low of 0.7533 last seen on 2nd April to break the 80 cents barrier. But prices have since retreated significantly over the past weeks. So in the near term, or at least for the third quarter, the real question would be if the currency pair would continue to trade higher, or will the 70 cents against the US dollar be a real possibility? In order to answer this, we explore the possibility of any kind of additional easing in the following months. The Reserve Bank of Australia, RBA, will depend on three interrelated primary factors. First, the Australia Consumer Price Index, CPI. Second, housing prices. And last, commodity prices. As seen on the diagram, in the first quarter of 2015, CPI increased 1.3% of the past year, which is reasonably low, and its core inflation stands at 2.35%. This is still within the RBA's target band of 2 to 3%. So with no inflation at risk, will RBA continue additional rate cuts and introduce more easing policy? With the expectation that Australia's CPI or inflation should pick up in the third quarter, my assumption is that the RBA stays on hold for an extended period. Apart from inflation, we see strong housing prices as the main hurdle to a rate cut, where the RBA is hoping that macro-prudential measures will take the heat out of the housing market. Any further cuts might foster imbalances, as RBA needs to weigh the need to boost the economic growth while keeping Sydney and Melbourne housing prices under control. Lastly, I do not expect commodity prices to be kept low for long. We are already seeing an uptick from both the iron ore and crude oil market, with both commodities being Australia's major source of export. In summary, when commodity prices move higher and property market continues to boil, I expect to see no further easing, and this would keep the Aussie dollar well supported at current levels. That being said, I don't foresee prices to staying high throughout the year. The US is widely expected to hike its interest rate in the last quarter, normalizing its monetary policy by returning the Fed fund rates to 3.5% by end 2017. Hence, I will foresee the benchmark dollar index DXY breaking out of its post-2008 crisis range, embarking on a strong recovery. In this scenario, my year-end Aussie dollar target should likely be under 70 cents. With this, we have come to the end of this week's edition of Market Watch. For more information on the risk and return of investing in Aussie dollar markets, you may approach any representative from Phillip Futures. Please subscribe to us on PhillipCapital YouTube channel and Facebook, and stay tuned for more Market Watch videos. Thank you and have a good week ahead.